Imagine this: your elderly parent has a substantial nest egg, but a well-meaning advisor suggests a strategy that could actually shrink their legacy. This is the situation Beth found herself in when seeking guidance for her 80-year-old mother, Susan. Susan, a widow residing in a retirement home with declining health, faces a common dilemma: how to manage her substantial assets, the $1.2 million RRIF, $300,000 TFSA, and $1.2 million in a taxable account to ensure financial security for her remaining years and potentially leave a legacy. Susan's annual expenses total around $60,000, covered by a survivor pension, CPP, and her investments, primarily Canadian dividend-paying stocks. 3 years ago, concerned about a potential hefty tax bill upon Susan's passing, Beth, acting on her accountant's advice, requested Susan's advisor to significantly increase RRIF withdrawals beyond the minimum. The logic seemed sound: withdraw more now, pay some tax, and reduce future estate taxes. But here's where it gets controversial. While this strategy aimed to minimize future taxes, it resulted in Susan being taxed at Ontario's highest marginal rates, the staggering 53.53% on a portion of her withdrawals. This raises a crucial question: is it truly beneficial to pay top tax rates today, only to move the remaining funds into a taxable account where they'll be subject to ongoing taxation on dividends, interest, and future capital gains? This seemingly counterintuitive approach highlights a common misconception. RRIFs, even in later life, remain powerful tax shelters. Withdrawing excess funds triggers high marginal tax rates and exposes the money to continuous taxation within the taxable account, gradually eroding wealth over time. And this is the part most people miss. At Susan's age, the minimum RRIF withdrawal rate of 6.82% already comfortably covers her expenses, taxes, and TFSA contributions. There's no need for additional withdrawals, which only serve to accelerate tax liability and diminish the tax-sheltered growth potential of the RRIF. A comparative analysis reveals a surprising truth. Sticking to the minimum RRIF withdrawals leaves a larger RRIF balance at death, resulting in a higher terminal tax bill. However, it also leads to significantly more after-tax wealth overall. By minimizing taxes during Susan's lifetime and preserving the RRIF's tax-deferred growth, the estate ultimately benefits. This scenario underscores a crucial principle in tax planning: deferral is key. While Susan can no longer benefit from income splitting, deferring taxes within the RRIF allows her capital to grow undisturbed, maximizing her legacy. So, is aggressively withdrawing from a RRIF to avoid future taxes a sound strategy? The numbers suggest otherwise. Sometimes, the most effective approach is the least flashy: adhering to the minimum RRIF withdrawal and allowing the tax-sheltered growth to work its magic. What are your thoughts? Do you agree that minimizing withdrawals and prioritizing tax deferral is the best strategy for seniors like Susan? Share your insights in the comments below. Now, shifting gears to this week's roundup. The holiday season is upon us, and Lindsay and I are taking a well-deserved break after a fantastic year. Our children still have a week of school, so we'll be focusing on last-minute holiday preparations. Last week, I shared my Globe and Mail op-ed advocating for RRIF reform to address the challenges faced by single seniors. Thank you for your thoughtful comments. Here are some valuable resources to explore. Worried about outliving your savings? Check out these 8 tips to ease retirement anxiety. https://www.morningstar.com/personal-finance/8-tips-stop-worrying-about-running-out-money-retirement. https://www.morningstar.com/personal-finance/8-tips-stop-worrying-about-running-out-money-retirement. Considering part-time work in retirement. Be mindful of potential clawbacks. https://www.theglobeandmail.com/investing/part-time-work-in-retirement-benefits- https://www.theglobeandmail.com/investing/article-part-time-work-in-retirement-benefits- Looking for insightful investment reads. Nick Majuli curates his favorite investment writing of 2025. https://my-favorite-investment-writing-of-2025 https://my-favorite-investment-writing-of-2025 Visual Learner. Michael James on Money explains alternative investments with a simple graphic. https://www.michaeljameson-money.com/2025/12/alternative-investments.html https://www.michaeljameson-money.com/2025/12/alternative-investments.html Aspiring to be a moderate millionaire. Ben Carlson shares his insights. https://a-wealth-of-common-sense.com/2025/how-to-become-a-moderate-millionaire https://2025/2025/how-to-become-a-moderate-millionaire. Revisiting a classic. Ben Felix reviews the timeless lessons of The Wealthy Barber video link. Received a bonus. Heather and Doug Bonepath offer guidance. https://www.readthejointaccount.com/p/received-bonus https://www.readthejointaccount.com/p/received-bonus Airport lounges losing their luster. Barry Choi explores the changing landscape. https://www.theglobeandmail.com Investing Personal Finance article Airport Lounges Exclusive Credit Card Benefits Air Canada American https://www.theglobeandmail.com Investing Personal Finance article Airport Lounges Exclusive Credit Card Benefits Air Canada American. Wishing you all a wonderful weekend.